One of Canada's largest banks starts cutting jobs, a warning of a recession. So let's get right into this. This happened, of course, on their earnings call. Canada's largest bank, RBC, warns of softer economy, plans to cut jobs. RBC warned of a slowing domestic growth, including slowing wage growth, lower job postings, and a rise in unemployment. And think about slowing wage growth right now with how much negative real wage growth we actually have when you use a inflation number, which is more accurate, like we used the other week. And think about this with what we discussed yesterday in terms of the free money, essentially, that they're stealing from taxpayers for parking reserves at the Bank of Canada, which the Bank of Canada created in 2021 and 2020, which we discussed yesterday. So bear that in mind whilst we go through this. So Royal Bank of Canada, RBC, warned of a softer economy ahead and plans to cut about 1,800 jobs after Canada's largest bank beat analysts' estimates for the third quarter on Thursday, helped by cost-cutting measures. So they're cutting jobs. So that doesn't send a sign of a very stable company, does it? Obviously, if a company is doing well and they want to grow, then they're taking on people. So obviously, this is a sign that the banking sector in Canada is contracting, and you only have to look at the money supply to realize that as well. So Chief Executive Officer Dave McKay forecasts slowing growth and lower inflation due to the lagging impact of monetary policy, combined with a slowdown in China, elevated climate and geopolitical risks. Well, the climate risks are out there because they writ all these loans to businesses, 90% of them, which weren't making money, just to literally satisfy this green agenda during 2020 and 2021 when this unprecedented amount of money was created. So that is just kind of crazy. And then another thing that they're pointing to is the slowdown in China. Hold on a second, because I didn't think that the China slowdown would affect us here in Canada. Obviously, I'm being sarcastic when I say that. I've been talking about this for a couple of months and a couple of years, since 2021 when Evergrande failed. Now we've got Country Garden also failing, and the Chinese economy in general failing right now because of weak export demand. People aren't importing as much stuff because guess what? The Western economies like the United States and Canada are heading into a recession, and that's essentially what they're saying. They don't want to use that word, but that is exactly what they're saying. We are seeing evidence of a slowing labor market, as evidenced by slowing wage growth, lower job postings, and an increase in Canadian unemployment. Consequently, our base case forecasts a softer economic outlook, he told analysts. And really, they're being quite rosy when they talk about this, but this is typical on an earnings call. The operating environment is changing faster at a faster pace than we've seen for over a decade. So just think about that. He's talking about the banking sector is changing rapidly right now, and the stability of that sector is in question right now as well, at least by people who are thinking critically, are looking at the amount of negative amortization mortgages that they're holding and thinking, what the hell is going on? I mean, we talked about this on Monday. It is an absolutely insane amount that they're holding, but this just kind of shows how, they're managing to hold it together on these earnings calls. The bank stock is actually up since the earnings came out, so the market has seen this, RBC, it's good that they're cutting jobs, everything is fine. But this is kind of typical as you head into a recession. The stock market is always the last thing when the final shoe drops and they realize that the economy is going into a recession. This no landing, soft landing scenario just doesn't exist and never does exist. So let's continue on here and see what else they're saying. The operating environment is changing at a faster pace than we've seen for over a decade. McKay in May said that the lender would slow down hiring after it overshot by thousands of people. The bank said the number of full-time employees was down 1% from the prior quarter and expects to further reduce headcount by about 1 to 2%. The bank had 93,753 full-time employees as of July 31st. That is a huge amount. Think about that. That is a massive amount. If you just think about the unemployment change in terms of job numbers, they will actually have a big impact on those numbers because they're large institutions. They're big parts of the Canadian finance economy and the Ponzi housing market. So the country's second largest bank, Toronto Dominion Bank, TD, however, missed analyst estimates for quarterly profit, which was hurt by higher expenses, rainy day funds to cover unpaid loans, weakness in its US business, talking about some of the acquisitions and takeovers that it's done and the money it might be on the hook for in the US. But interestingly enough, they're talking about those loan loss provisions going up. The regulators asked them to step it up a little bit. But it's like we understand on this channel, the regulator is in bed with the banks. All the regulator is doing is virtue signaling, coming out into the public and saying, hey, you know, we're telling the banks, increase your loan loss provisions to less than 1% of your loan portfolio and everything's going to be fine. But when they come out and say they're increasing it by 500 million, if you don't know how many loans the bank has, you think, wow, that's a lot of money. But it's actually nothing when you're talking about $1 trillion worth of loans, which the Royal Bank of Canada, we know, has more than that. So you just have to bear that in mind. TD set aside 766 million Canadian dollars, a jump from 351 million Canadian dollars, 274 million US a year ago, whilst RBC set aside 600 million Canadian dollars, around 455 million US for credit losses, up from 340 million Canadian dollars, 266 million US. I mean, that is just, it's peanuts. It's fuck all. They're really just setting aside fuck all. It's just no more than virtue signaling. And just look at who is at the head and the helm of the regulator. It's ex-bankers. Can you really trust people in charge of a regulator who come from the banking system that they are trying to regulate? I mean, there is a massive conflict of interest. It reminds me of The Big Short when the regulator is tapping up that guy at Goldman in Vegas for a job opportunity, and that one guy from that brownfield fund or whatever is like, isn't that against the law? Shouldn't you not be doing that? And she's like, shut up, that's not against the law. And that's exactly what's similarly happening here in Canada with the regulator being in bed with the banks. Not just the regulator though, it goes right through to the CMHC as well, which is technically a crown corporation. So it just goes to show how incestuous this industry really is, the banking industry, and it's just kind of crazy. So that's what's happening there. If you look at RBC's earnings, I just want to show you the growth and what's kind of happened with their revenue and their diluted earnings per share. So you can see here that you're talking about 14.49 billion in revenue. So their revenue has increased tremendously. But if you look at their costs, you can see that they're kind of all over the place. They're not actually the peak of what they've been in the past. If you look, 2.84, they've had more than that back in March 2023 when they reported, I'm guessing for Q4 2022. So you can see how it's kind of fluctuated. It's interesting. I'll leave that in the description as well. But you know, you can expect costs to rise. I mean, they're not setting aside enough here for these defaults, considering the risk that they know is already in the system, because they're looking at their loan book, they're talking to their consumers, they see what they're spending and they see that amount is down. We talked about it a few weeks ago with TD reporting that people's spending was down. So they know what's coming. They know people can't afford to pay their mortgage. We talked about it, 22% according to a recent poll. You know, during the financial crisis at the peak, the default rate was at 11.5%. And you've got in recent polls here in Canada, 22% saying they can't afford their mortgage. This is with negative amortization and all the other shit that the banks are pulling right now. And they've been pulling since 2020, guys, with the mortgage deferrals. They've been trying to contain this and they've been doing a shit job of it. And eventually it's just going to spill out and be exposed to the whole world that this was just a massive housing market bubble, as it is evidenced when you look at it compared to incomes and affordability and fundamental metrics which are historically used for housing going back hundreds of years. So anyway, very interesting. You've also got Bank of America warning Canadian banks should brace for challenges ahead. Not sure what they quite mean by that, but they're talking about the fact that they might have to bear the brunt of higher expenses. You know, what's happened in the US is a lot of deposit flight as well. You could definitely see that happening in Canada. And you know, another thing that I want to go over quickly is you have to remember these banks are earning insane amounts just by parking reserves at the Bank of Canada. They're getting loads of money, essentially, for parking money at the Bank of Canada, billions of dollars, in fact, and those are that's showing up on their earnings. So their earnings should be up a lot more than they actually are. So you've got to kind of question what's going on here. And they're not going to be able to keep this going for a long time. And what's happening with Canadian unemployment? We've obviously seen this chart. Canadian unemployment is rising. We've got more figures coming out, and we'll be doing a video on that as they come out. You've also got GDP, which I talked about. This is the month-over-month number. You know, when you're talking about 0.1, 0, 0.1, lost a point there, 0.1 again, 0.1, 0.1, you know, you're talking about 0.6, 0.3. You're talking about the economy really just being flat when you think about it since August of last year. But when you actually deflate that with a more realistic number for inflation, we're already in a recession. And this is what I keep telling people. Prepare right now, because we're already in a recession. You only have to look at the PMIs and the growth numbers to figure that out, as we've looked at many times on this channel. And there is major problems coming up as well with the CEBA repayment deadline that we've talked about many times on this channel. The federal government is giving little indication that they're going to extend this. I mean, it's difficult for them to extend this without issuing more deficits and then completely going on the opposite of what they're doing in the Bank of Canada. And obviously their interest expense right now is much, much higher. So they're unable to finance this at a low interest rate like they did in 2020 and 2021. So, you know, it's crazy. This is a lot. Businesses are extremely worried. We have to remember that 9 out of 10 small businesses took out the CEBA loans. Based on our research, only 10% have fully repaid. So that shows you the economy is not as rosy as you're being led to believe. The recovery that happened was mostly a recovery because of real estate, housing, government spending. Small businesses, the private sector has been absolutely hammered by the pandemic, and the scars are everywhere. I mean, I was talking to a hotel manager who manages 2 hotels here in Canada, and he told me they lost over $10 million during 2020 and 2021. And even though that they're at full occupancy right now, they've nowhere near recovered that. And just think about that amount of money, the debt that they now have, and how that's rolling over at higher interest rates, and we're about to head into a recession. Think about all those hospitality jobs that have been created and how weak these businesses essentially are under the hood because of what happened in the pandemic. So there is a humongous risk here of mass layoffs coming in very, very quickly. And what will that lead to in terms of default rates on mortgages? We already know people have been pushed to the absolute maximum right now. The banks have done everything they possibly can to alleviate defaults, and it's still gonna happen. We haven't even got to the last domino falling, which is unemployment. So it's gonna get gnarly, guys. It's gonna get really gnarly. Make sure your banking is diversified. Make sure you don't hold all your money in one bank. And I'm not saying that because banks are gonna go bust overnight or anything like that, even though that could happen with smaller banks, definitely. But your money would likely be protected if you've got it CDIC insured. But you just need to make sure that you have your banking spread out, diversified. So in the event that there's these outages or anything happens, you've got access to money and liquidity when you need it. And it's just very important, in my opinion, to have that. Canadian businesses took out an average of $100,000 in loans due to the pandemic, and surveys by the CFIB show that about half of businesses are still earning less than they were prior to the pandemic. So this is not the economy that you have been led to believe exists right now at all. There is a ton of weak businesses, and the economy has just been massively distorted. As I've been saying the whole time, it's been massively distorted by stimulus, low interest rates, all the loans, all the deferrals that happened, and things are going to get really bad. Over $100,000. And just think about that. They're paying that at like 7, 8%, 9%, 10%, 11%, 12% interest rates right now. It's a crazy amount. Businesses aren't going to be able to afford that, and spending, people are cutting back on spending. They're going on more local vacations because they can't afford to go on international vacations. People are cutting back. The polls and data show it. So anyway, very, very interesting what's going on there, and sad, really. And And then you look at this as well. Average rent in Canada hit a new record high in July. This is not going to last. And the problem is, when you think about places like Calgary, let's use Calgary as an example, because Calgary's market has been distorted as well. You've got a lot of Airbnb inventory and a massive rise in growth in Airbnb inventory here in Calgary right now. Obviously, the unemployment is higher. It's one of the highest in Canada. But think about it. When you think of Calgary rent prices right now, they're like at all-time high prices right now. So anybody who invests in the housing market and thinks this is the rent that is it's going to be like this forever is just delusional, because you've only got to look and talk to landlords like I have to realize the credit quality is terrible right now of the tenants coming in. So even though the rents have gone up, it's very hard to find a tenant that is a good tenant with good credit right now, which shows you how bad things really are. And in the future, because of the revenue declines in Airbnb in Calgary, Montreal, Toronto, Vancouver, you're going to see more and more Airbnbs that are flipped to long-term rentals or sold onto the housing market, depending on how things go. And not only that, you're going to see more and more people defaulting on their rent, which is going to lead to more and more problems, because a lot of these landlords cannot afford to keep the rental going without the rent. So they are completely screwed when the renter stops paying, when the courts are backlogged, they can't get them out, and they're stuck trying to pay the mortgage for 6 months. And then they lose one income because there's a massive economic recession, which is evidenced in the yield curve. And it's been predicting this for a long time, over a year now, since last June. So we know how bad this is going to get. And it's obvious to see how everything is just so leveraged that it only takes unemployment to hit and boom, you've got major problems everywhere in the rental market, in the housing market, with small businesses as well. It's absolutely everywhere. This is a huge credit bubble. It's not just housing, it's also businesses. And that's what people need to realize and understand and prepare for. Like I said, be fearful when others are greedy. And right now, people are being greedy and they don't think that there's going to be a recession. They think the soft landing, no landing, that's going to happen. But anyway, guys, I want to thank you so much for watching. If you've enjoyed this, you might like this playlist I've picked out for you. You might like this video here that I picked out for you. If you're looking for a VPN, use my VPN provider, expressvpn.com/marketmania, linked in the pinned comment. Thank you again